I'm Bob Bednarz. I'm with Guarantee Mortgage. I've been a mortgage broker for, oh gosh, almost 30 years now. I like to call myself your lender for life. I'm a residential mortgage broker primarily, but do some commercial, some construction. But my forte is residential mortgages, and I love working with first-time home buyers. So that's why I thought this would be a good day to do some presentation because there's lots and lots of first-time home buyer programs out there. And if you're not a first-time home buyer and you're selling to first-time home buyers, it's good to get all this information. So I'm going to go ahead and share my screen and go to a PowerPoint presentation. So let's see if I can get the full screen. And there we go. Okay, so you can buy a home even if you think you can't. And that's what the whole focus of this is about. Whether you're a first-time home buyer or not, there's lots of loan programs, but there are so many out there to help homeowners become part of, well, to help people who don't own a home become a home. That it's incredible, and it's nice to take advantage of a lot of these programs that are out here. There's community programs, there's state programs, there's federal programs, there's just a whole bunch of them. So again, I'm Bob Bednarz. I'm a loan advisor with Guarantee Mortgage. My contact information is here. In fact, there's a lot of stuff that I have on this PowerPoint. If anybody wants to have a copy of the PowerPoint presentation, just let me know. Here's my email address and phone number. And a lot of you already know me. If not, you can put the information in the chat or reach out to me directly because there's some good stuff here. So first of all, let's talk about who a first-time home buyer is. And basically, a first-time home buyer is someone who has no ownership interest in any residential property for the last 3 years. And this applies to properties anywhere. And it's 3 years preceding the date of the application. So technically, you could have owned a home 4 years ago if you sold it 4 years ago and still be considered a first-time home buyer. It's like becoming a virgin again. So good news is no ownership in the last 3 years, you're still considered a first-time home buyer. So what's important on most first-time homebuyer programs is you have to have homebuyer education for most of them. I think we have Gary Behringer from Luther Burbank Savings talking about theirs. I don't know if they require it, but the other ones that I'm talking about will. And you can see there's all sorts of different resources where you can get homebuyer education. It's very important, even if you're not well, let's put it this way. I'll give you a quick story. I have a first-time homebuyer couple. We're getting ready to close escrow, and they have their parents putting in the down payment, a big chunk of it too. So in their head, they thought, oh, down payment, parents taking care of us, we're covered. So we go through the disclosure process, we go through the whole escrow process, we're getting ready to order loan documents, and we have to confirm where the funds to close are coming from. And so parents are only going to do a down payment, and the kids are going, and I said, well, who's paying? Your parents are paying the down payment, you're paying the closing costs. And the kids said, closing costs? What are those? And so it's like that far in the process, you should really know what you're getting yourself into and what it costs, because it's something you don't want to enter into lightly. And so as I like to put it to people, when you're buying a home, you're putting yourself into probably the biggest debt you're ever going to be to in your entire life. So you want to make sure you're doing it with knowing what you're doing. So homebuyer education is important. So real quickly, I'm going to give a real quick homebuyer education of what we look for in a mortgage, and then how we can help people who are lacking in one of these 5 areas. So there's 5 C's of credit where we approve a loan, and quickly they're just character, capacity, capital, collateral, and conditions. There's no quiz at the end, so you don't have to worry about it, but I'll go through them quickly. First of all, character is your credit history. Obviously, you got to pay your bills on time. You don't want to rack up too much debt, but everybody knows about credit scores and are so worried or protective of them. So as long as you're doing the first 2, your credit scores are going to probably be pretty good. Second one is your capacity, your debt to income ratio. So you've got to be able to afford what you're buying. So in this case, there's $1 million purchase price, $235,000 down payment, $765 loan amount. You have your principal and interest payment, but you also have homeowners insurance and property tax. You have to come into that. So even though you have a principal and interest payment of $3,200 a month, all the other stuff on a monthly basis comes to $4,400. So you got to factor that in. And also your extra debt, like let's say you have a $550 car loan. So you throw that in there and your total monthly expense is going to be $4,900 a month. And if you divide that into 12,000, if that's what you make a month, then your debt to income ratio is 41%. So that's how I come up with it when I talk about this a little later on. Capital, how much money are you going to put in your transaction? So like I said, it's not only down payment, it's closing costs. And a lot of times, especially for jumbo loans, you have to have leftover reserves too. So you want to make sure you're not wiping yourself completely out. So again, it's not just down payment, it's closing costs and what you're going to have left over as a cushion. Then there's the collateral. It's your property. Is it a condo? Is it a single family home? Are you over asking too much for it? Because if you offer way higher than what the market price will be, and you get a property appraisal to verify that purchase price or market value, if the market value is lower than your offer price, then you're going to have to pay the difference between your purchase price, your offer, and the market value. Let's say the purchase price is $1 million and you offered $1,050,000. And if it appraised, if you offer $1 million and it only appraises for 900,000, you're going to have to come up with that difference of not 100,000 plus the down payment, or it's a little more complicated in the calculation, but you can get the idea. You want to make sure that you're not overpaying for a property because you might have to lay out some more cash if you really want it. And finally, it's the conditions, the purpose of the loan. What's your focus on buying the property? So obviously you're buying a home, but the reason I bring this up is sometimes people want to do these first-time homebuyer program loans to get into a property, but they aren't going to live in it. They're going to try to pull a fast one and maybe, do Airbnb or something like that. And you really got to be careful. You can't do that. It's example, I heard of a case in San Francisco where a buyer bought a below market rate unit, and after they bought it, they went out and Airbnb'd it. And the city has a database of that, and they found out. And so this home buyer not only had to have the loan and the property come due and payable, they had to pay the city a $250,000 fine for fraudulently buying that property. So stay clear. If you're trying to do a fix and flip, if you're trying to buy investment property, these first-time homebuyer programs are not for you. These are for you if you're trying to get into a home and you might have some little difficulty in this expensive market we live in. So what I'm going to focus on today is conforming loans, not jumbo loans, because a lot of banks that do jumbo loans have special programs. Conforming loans are the ones that are pretty much either Fannie Mae or Freddie Mac or FHA or VA, where if they're not owned by the government, they're kind of quasi-government owned. And they cover about 90% of the mortgages written in the United States. However, we're in a very expensive market. So you can see if you have a one-unit building or like a single family home or a condo in San Francisco, and you want a conforming loan, the limit on the loan limit is $510,000. Or if you get a fourplex, it goes up to $981. But we're considered a high cost area. So we get a little bump on that. So you can get a loan amount up to $765,000 on a conforming loan, or on a 4-unit building up to 1.4, which, I'm going to talk a little bit about this later on between the two different products, but just to kind of give you a baseline of where we're going with on these loan programs. And also, real quick, we're kind of expecting an extra 5% bump on these loans. So you might be able to get for a single family home or condo, a conforming loan over $800,000 potentially. We'll know in a couple weeks. So here are the 5 homebuyer programs that we're going to be talking about: Fannie Mae Home Ready, Freddie Mac Home Possible. Those are the 2 biggest loan entities that we have making loans in the United States, as I mentioned. I'm not going to talk about FHA. I'm not going to talk about VA. They're a little more complicated. FHA can help with credit challenged borrowers. VA can help if you're a veteran, especially with no down payment. But, because there's so many other things I wanted to talk about, we'll just focus on these 2. And then there's a program called Cal HFA, which is a statewide program. in California. Gary Behringer's here with Luther Burbank. He's going to talk about his DAISY program. And I'm going to follow it up because San Francisco has a unique below market rate unit and down payment assistance program combination that is kind of unique, but it's very popular. And it's a little different than the regular ones, but there's so many available options to use them in the city of San Francisco that I wanted to, kind of make sure to highlight it. So let's start out with the Fannie Mae Home Ready. Basically, Fannie Mae has their special product that can help low-income borrowers. That means your median income can't exceed the annual area median income for the area. So for San Francisco, the annual median income is $127,900. 80% of that is $102,300. So if you make that or less, you're eligible for this program. Also, remember I talked about debt to income ratio, your total housing expense, your actually total monthly expense divided into your monthly income. They'll stretch it. Normally you can only go to 43% on most loans. On this one, you can go up to 50%. So half of your income can go to your housing expense if you don't have any other expense. So add in the other expense and your housing expense, divide that into your monthly income. If you're 50%, you're eligible. So here's how it works with the down payment. If you have one unit property, you can put 3% down and you can have 105% financing, meaning you can get down payment assistance and closing costs for more than the value of your property. And I'll talk a little bit about that later. And your credit score can be as low as 620. Now, if you have 2 units, it's a 15% down program. If it's 3 to 4 units, it's 25% down. And if you're a high balance loan, meaning above 510 or below 765, these programs apply for up to 95% of your property, or a combination of another 2% for some of the down payment assistance programs. And the down payment assistance has to come from what they call a community second. So what that means is, so Fannie Mae does the first mortgage, and we're trying to come up with the extra money for down payment and closing costs from another source. And so a community second is something that's provided by a federal agency, a city, state, county, a local housing financing, or some other nonprofit organization under one of its affordable housing programs. A couple of examples. One is something called the NeighborhoodLIFT Program. It's actually initiated by Wells Fargo Bank, but other banks can use it. And it's here to boost ownership for the San Francisco Bay Area and these counties, and can provide up to $250,000 in down payment assistance and up to 359 households earning 80% of that AMI, area median income, that I talked about earlier. And I think funds are used up for this year, but they're starting with the new funding for this in February 1st. Another one is called a WISH program. It's a subsidy that, again, has a matching grant up to $22,000 per household. This one gets a little tricky. Now, I talked about an average median income. When I get further away from Fannie Mae and Freddie Mac, different agencies are going to consider average median income different ways. So you can see in this particular WISH program for this community second, a one-person AMI income is lower at $97,600, and it can depend and go bigger depending on the size of your household. It's a little complicated, but I just want to give you an idea of they're available. Now, Freddie Mac has got their Home Possible program. It's very similar to Fannie Mae, except in some important things. Again, it's still low income. It's still the average median income at 80% for San Francisco is $102,300. They'll go a little higher on debt to income ratio, up to 50.49%. And believe me, that 0.49% that you can get here and not at Fannie Mae, I've taken advantage of that a couple of times to get people into a home, because sometimes it's that close. But the best thing about Freddie Mac is they will do the one unit financing like Fannie Mae, but if you're doing a 2 to 4 unit property, you can get up to 5% down for a 4 unit property. And so if you go back to that conforming, let's see if I can roll it back a little. If you go back to that conforming loan amount limit, sorry about that. You can see on a conforming loan, 510,000 is only for a 1 unit, but 981,000 for a 4-unit building. Whereas you got to put 25% down for Fannie Mae, you only have to put 5% down for Freddie Mac. So that's a big difference for people that wanted to kind of help with buying a home and have some rental incomes to help them pay the mortgage. If they go into that high balance though, on Freddie Mac, it goes a little higher. It's 15% down for 2 units and 20% down to 3 to 4 units, but it's still higher than Fannie Mae. And of course, you can use these community seconds as well too. Freddie Mac likes to call them affordable seconds. They actually have something called a borrower smart grant for very low income borrowers, like between 50% and 80% average median income. They can actually get a grant, free money for $2,500. And another source is Golden State Finance Authority. This is a statewide program that provides 2 types of down payment assistance that are really popular. And it can go up to the $765,000 maximum conforming loan limit for this area. What they'll do for that second, remember, we can go up to 97% on the first mortgage or 95% on a high balance. They can offer like 5% on a loan and defer the payment on it, no payments, and after 3 years, they forgive the loan. Or they can go even higher on this open doors policy where they can give you up to 7%. So you can get more than 100% financing, and it'll match the terms of your loan. So if you have a 30-year loan, it can do a 30-year loan deferral. Now, this isn't forgiveness. You have to pay back the interest, or you have to pay back the loan when you either sell or refinance, but it's a 0% interest rate, and it's not free money, but it's great cash flow. And that brings me into another program by California Housing Authority called Cal HFA. And these 2 previous down payment assistance programs help with this well too. What's nice about this program, it's for not so low income. Because remember, some of the prices here in the San Francisco area are expensive. And if you're going to only make $100 and some thousand a year, the 2 might not match up. But the San Francisco average median income for this particular program for the Cal HFA is $236,000. That brings in a lot of potential new borrowers that can be still qualified for this first-time homebuyer program. The debt-to-income ratio is a little lower at 45%, but because you can allow for more income, you're going to have yourself more potential for the realtors, more buyers. And on this one, it's only for single-family homes, although accessory dwelling units are allowed. That means you can have a single-family loan with an in-law unit if it's legal. And you can do 97% financing up to that 765 loan amount. You can get another 7%, like that second loan I was telling you about, the deferred one, where you can get down payment and closing costs to get close to that 105%. And your credit score, minimum credit score of 660 is not too bad. And again, it's a little adjustment for the high balance loan. The first mortgage will only go to 95% instead of 97, but you can still get those seconds to go with it. And on top of that, Cal, and I'm going fast, so I'm sure you guys are going to have a lot of questions, and it's just, I realize I put a lot of detail in here, but I just want to let you know there's just so many programs available. And again, with Cal HFA, there's 2 additional down payment assistance programs that they have. One is called Cal Plus. You can get either 2% or 3% of your loan to value, which can make up your down payment, even some of your closing costs, on a 0 interest rate program. It matches the term of the first mortgage, and the payments are deferred for the life of the loan. So again, you're not paying any interest on it. All you're paying the loan back is if, let's say you buy the home for $1 million now and you sell it in 15 years for $1.5 million. If the maximum loan amount you needed to get into this property was $10,000, all you got to do is pay the $10,000 back when you sell the property. It's just a great way to make profit on a property without having to put a lot of your own money into the deal, especially if you qualify for this. So now there's another program called the DAISY program with Luther Burbank. And Gary, you want to, like, I put some information in here if you want to tell us a little bit about it.
Bob, and thanks again for having me. So the DAISY, our program, the DAISY is a down payment assistance program, and it's tied to our 30-year fixed grow program. But the DAISY down payment assistance second is basically 2% of the purchase price, and it is free money. It is 0% interest, so there are no payments. It's forgiven over 3 years. It's forgiven 25% in years 1 and years 2, and 50% in year 3. And it allows a total of 3% down, which means the borrower needs 1% down payment and have the ability to have 1 month's payment in reserves after close. So it's an aggressive program for us. It's it's the bank's CRA product. And a CRA product is basically the government's Community Reinvestment Act, and it makes sure that all banks and lending institutions serve all the communities in which they have brick and mortar locations, branch locations for us. Bob, you touched base on a couple of things. You'd asked if Homebuyers Education was required for the Grow DAISY combination. It is. Most borrowers go online to do it, as long as it's a HUD approved course. That's very important, because once a borrower completes it, they'll be given a certificate. And once again, it'll reflect that it's a HUD approved course, HUD meaning Housing and Urban Development. In terms of first time home buyers, for us, borrowers don't have to be first time home buyers, but they just can't own any other property at time of funding. In other words, they could own a current primary residence and be selling it concurrently to buy this new property. That's absolutely fine, but they don't have to be first-time home buyers, which is important.
Well, what I like about your program is all the other loan programs have mortgage insurance. You do not.
Right. It's self-insured, meaning it's built into the rate. And keep in mind too that with our program, that a property doesn't have to be in a low to moderate income census tract. If it is, then there's no limit to income, to the borrower's income. They can have non-occupant co-borrowing parents or relatives to co-sign. There's no income limits. If the property falls outside of a low to moderate income census tract, then you would be restricted to the annual incomes on a rate sheet. And to give you an example, in San Francisco, the combined annual income of all borrowers, in case there's relatives that are co-signing, is currently $184,480. So that's an aggressive number, and it's for 1 to 2 unit properties, which is nice. So
yeah, and it's great. It's forgivable after 3 years, right?
The DAISY down payment assistance that's correct.
It's free money. If you hold on to that property, it's free money, and no payment required, and no needing to pay it back. Right. So I think that's a great program.
Thank you, Bob.
You're welcome. And then I'm going to finish up on the San Francisco BMR programs. So, many cities and communities have their own programs for below market rate units and down payment assistance. San Francisco's is probably the most complicated. I mean, I've done them in Emeryville, I've done them in Sonoma. They're not complicated. San Francisco's is very complicated. I had to get myself certified in it and take the education course, and they have a lot of things moving around. But there's so much available to buy, and the volume of what you can get in San Francisco makes it worthwhile, especially if you're a first-time home buyer and you're not making 6-digit figures and still want to live here. So to kind of give you a quick idea, San Francisco has 3 different programs. Their below market rate program, their loan assistance programs, and they have mortgage credit certification, which is a mortgage, you get property tax credit. Unfortunately, I'm not going to talk about that because starting the first of the year, they ran out of funds for that. So for now, there's no mortgage certification program until that money comes back. So basically, it would just be these 2 programs for first-time home buyers. How you apply, again, in San Francisco's case, before you even come to me, you have to go get your home buyer education. Like if I get you pre-approved and send them a pre-approval letter, if you don't have your home buyer education certificate, you're out of luck. You got to do that step one first. So that's why I got to really stress people on these programs have to do their home buyer education. Then you get pre-approved with me, and then you submit it to the Mayor's Office of Housing and Community Development. And how it works is they put you in a lottery for certain properties for the BMRs, and they have for down payment assistance. If you're in a regular market rate, you can actually get up to $375,000 on a deferred second loan from San Francisco. $375,000, but you have to go in a lottery on that, and that could be on any market rate home. They even have more for first-time responders, which is that second one, and for educators. And then there's another one where they have first come, first served basis. And they have community seconds on properties from an old program. There are certain properties designated in the city where you can get what they call a city second, up to $375,000. And they have some other programs like Teacher Next Door, and you can get down payment assistance on the below market rate units as well. So there's a lot going on, but it's a lot available. So how it works then is you go to the lottery, and when you get picked for the lottery, then you put in a full application to the Mayor's Office of Housing, and then you get a conditional approval from them after you've gone through the pre-approval process with me. Then if they accept you, you go into a sales contract. Then you get my first full loan approval, and then we go back and we get the BMR or down payment assistance approval from the city. And then we fund and close. On these kind of properties with the city, you're going to need a minimum of 60-day close of escrow. So if any of the realtors are in here and you're used to quick close of escrows, think again. You got to repeat your thinking cap on. This takes a long time for the city of San Francisco. And how it works with the below market rate units is they want to keep the properties at a below market price to make them affordable. And you have limited resale coming on when you go around to sell it. So if you buy, how it works is I've done one, let's say in the Austin, I got one for a borrower, $400,000 for a brand new 2-bedroom condo over on Pine Street, which is normally worth about 1.4 million. But when that buyer goes back to sell it in a couple of years, he might not be able to sell it for more than 450 or 500, depending on the city's formula. So if you're looking to buy real estate as an investment in wealth, is getting an affordable home, this might not be the best for you because of this restriction. So kind of keep that in mind. But you can get a brand new condo for like $400,000 in San Francisco too. So your goals, like I talked about, that fifth of the 5 C's. What is your goal in buying a home? And that's what you got to be focused on. And so you can see San Francisco adjusts the median income for a whole bunch of stuff. Depends on the property. They can do 80% of the area median income. They can do up to 200%. And they'll do it on a per property basis. And it's based on household size, not just your income. So if you have a family of 4 and you've got looking at a property that when they say it's available for people with income of 200% AMI, you can actually earn up to $256,000 to get a below market rate or down payment assistance with the city of San Francisco. So it's complicated. From 70,000 to 256, it's all over the planet. So we got to be honed into on what property you're looking at. The city requires a minimum of 3% down payment. But you can get some down payment from some of those community second sources that I talked about as well. But again, the total financing, it has to be 97%. Yes, and they're a little weird. If you got a lot of money, like you want to put all cash down in a BMR, no, you got to have at least a 50% loan on it. They figure if you have enough money to buy a below market rate unit or try to get down payment assistance, well, you won't, if you're putting all cash, you won't need down payment assistance, but if you have enough money to put all cash on a property, you don't need a below market rate unit. So they'll make it a between. So what I have to do with San Francisco BMRs is I have to see how much you can get to your upper limit, but I also have to look at your lower limit too. So like I talked about debt to income ratio, the front end is your housing expense, your back end is everything else. So the back end ratio for the city of San Francisco for the most part is 45%. But you have to have a minimum of at least 28%. So there's a 2-pronged, you got to fit in between. And so you got to look at that. But what's really good about San Francisco is there's a lot available on their BMR units. Most new construction has to have at least, it used to be 10 or 20%. I think new construction now has to have at least 40% of the new units applied towards below market rate units. I have to get back to you on the exact one on that. But as you can see, these are all new projects being built in San Francisco. And of them, on the right-hand column there, you can see how many units are set aside for below market rate units. And the biggest one is this new one called MIRA, and near the Transbay terminal. They have 156 BMR homes in here and 236. So out of the 392 available, 156 in this new complex is going to be for below market rate units. So you can see these is like brand new stuff that are going to be like in a million, 2 million, who knows what the full price is, that you're going to have, like $400,000, $500,000, $600,000. It's an amazing deal. So it's a way to get into a great place. So anyway, that is all I have, and it's a lot of stuff. So I'm going to stop it here and open it up to questions or conversation or anything you'd like to talk about. And I can go back to the screen too if you want me to go over stuff, because I know I threw a lot of stuff at you all at once. Let's see, there's some questions in the chat here. Let's see what I got. Let's see, yes, I'd like to get a recording. This is excellent information. Okay, it's important to enter the lottery. Many people selected before you may not be ready. Yeah, that's true. Although in San Francisco, they're pretty particular. Like I said, there's a process. You've got to first have your Homebuyer's Education certificate, and then you have to get pre-approved by me. If you go to apply to the lottery and you don't have verification of both of them, then they'll kick you out. So yeah, you get kicked out even before they put you in the lottery if you don't have those first two processes. Karen has a BMR for sale for $545,000. No lottery. It's like she's got it there. So all right, there you go. Now there's something you can actually buy. You don't have to go in the lottery, and it's a BMR in San Francisco. Let's get Karen's property sold. Okay, so Gary, tell us a little bit about BMR units that are reviewed for eligibility with you. You're muted, Gary.
There we go. So BMR units typically carry deed restrictions. With the city, city has first right of refusal in many cities. And there's a limit to the appreciation because they want to make sure that these units remain affordable. So if you have a BMR unit and you're looking to finance it on a Grow Daisy, then we'll review the deed restrictions with underwriting in advance of file submission to make sure the project is eligible. So we do BMR units and mostly condos.
Do you do a lot of them in the city though?
I've had a few, mostly in the East Bay, some in the North Bay, but yeah, some in San Francisco. Yeah.
Yeah, because a lot of the cities aren't as restrictive as San Francisco. Because I've done them in Emeryville.
Yes.
There's some cities I've done them in, and you don't have to get pre-approved as a lender to do them. With San Francisco, not only my company had to get pre-approved, I personally had to get pre-approved to do them. And unfortunately, they will only let us go through our mortgage bank. I can't broker them out to like you, because you would be my broker that I could potentially send a loan to you for it. But the city of San Francisco won't let me do it because you're not part of my bank. You'd be a brokered loan. So
okay, good to know.
Yeah, so if you understand the system in San Francisco, then it makes it easier for the rest of the communities, because I haven't seen any community is so complicated and so widely crazy as San Francisco's. Yeah. Denise, yes, I don't have any of the information on cities for Los Angeles. First of all, the Cal HFA program, the Fannie Mae, Freddie Mac program, and Gary, you lend in Los Angeles County, don't you?
Yes.
Yeah, all the first 4 programs work for Los Angeles County. So the only one that wouldn't would be the San Francisco BMR program. But I think the city of Los Angeles would have something similar to what San Francisco has as far as below market rate units, down payment assistance. Um, I didn't have time to research it because I knew you were going to come online. I knew that question would come up, and I just, at the top of my head, I'm not really familiar with what's going on with the city of Los Angeles. But I don't think they'd be as complicated in San Francisco. I don't know why they make things harder in San Francisco, but if you know the politicians and the way the system works up here, it doesn't surprise me. Let's see, any more programs? I can talk a little bit about FHA and VA if you like. FHA, I don't like to talk about it because it can be expensive because they have very expensive mortgage insurance. Because all these programs, except for Gary's, have mortgage insurance, which is an extra monthly housing expense. What that means is because you're getting less than 20% down, you have to buy an insurance policy for the lender to insure them against you foreclosing on the property. So you're buying an insurance policy for the bank to make sure you're responsible. So on conventional loan programs, the mortgage insurance these days is not bad. I've done comparisons where you can do like 80-10-10 loans on conventional purchases, where you do a 80% first mortgage, you do a 10% second mortgage to avoid paying mortgage insurance for having less than 20% down. A lot of the times, mortgage insurance, especially if you got good credit, is cheap on doing a full 90% loan with 10% down. And that's why I don't think, like most realtors will, put the cross and the garlic up when they see mortgage insurance, and it's really not the truth. I do it when it comes to FHA, because FHA, you've got a monthly mortgage insurance payment that you have to pay for the life of the loan. On conventional loans, you can petition to remove the mortgage insurance within, after 2 years. And if you receive 20% equity in the property, your property value's gone up, so there's enough to remove it. With FHA loans, it stays for the life of the loan. So you can have an FHA loan for the whole 30 years and the entire 30 years pay the mortgage insurance. Also, when you apply for the loan and get the purchase loan, you've got to pay like 1.75% up front. You finance an upfront fee, which is like paying 1.75 points, and you pay monthly. It's like they get you as an initial cost, and they get you monthly. So that's why the only reason I would use it is you can go down to like a 580 credit score. You can go, you can get all your gift money. You can get all your money as gift. You don't have to have any of the down payment be your own funds. And your debt to income ratio can go up to 55%. So they're there for people that are kind of credit challenged. And I'll use them for that purpose. But if you can qualify for a conventional loan on any of these programs, I would much rather do that. And then VA loans are good, and you don't necessarily have to be a first-time home buyer to use them. VA has what they call a funding fee. They don't have mortgage insurance. They have an upfront fee, just like FHA has an upfront fee, which is kind of what their mortgage insurance, they call it funding fee. But you don't pay it monthly. So you can get up to 100% financing, 0% down. You pay an upfront funding fee for the first time. It's like 2.15% of the loan amount that you can finance in the loan amount. It's not cash out of your pocket. And if you can use it again, like if you're buying another home later on, let's say you're selling your home and you're buying a new one, you can use it again. And the funding fee is a little higher. I think generally it's like about 3.15%. And if you currently own a home and you get so much of what do they call it? You get so much that you can use on your VA program for total financing, your lending eligibility. And if you use so much up on the one property and you go to buy another property, whatever's left over, you can use on that property unless you're selling the departing residence. So you can technically own 2 loans and have 2 VA loans. It's just you only have so much eligible for you to use it. So you got to be careful on that. But for veterans, first-time home buyers, and even above the high balance conforming loan limit of 765, you can go up to like 1.5 million. You may have to pay a little bit of a down payment, but it's an awesome program for veterans. And again, you don't have to be a first-time home buyer, but you do have to be a veteran. So that's a little bit on FHA and VA. Any other programs? Anybody with stories on their first-time purchase, if there's anybody that's a first-time home buyer here? I'm just curious if anybody's actually used these programs.
So I went through all of these workshops and classes and everything else at the advice of my financial planner in 1990 in the Sacramento area. And I discovered for what I wanted to do, I ended up doing FHA, and I bought a foreclosure, and I bought a duplex in downtown Sacramento at the age of 19. So I've been volunteering for the San Francisco program for many years, and I don't know if we'll ever go back to doing that again, but it's amazing the stories that you hear from people that have used the program to get in. And the BMR program is not designed for people to get rich or anything like that. But when you think of housing security and securing your housing in San Francisco, I have some clients that have been in BMRs for probably close to 20 years, and they are able to build wealth in other areas because their housing is secure and they know how much they're going to have to pay. It's better than rent control. It's tax deductible in the early years. It's just an amazing program for people, and sometimes they outgrow it. They sell the BMR to somebody else who qualifies, and they buy a regular house somewhere, and it was good for them, and it helped them get a leg up when they needed it. So I was not able to use a BMR for myself, but these programs are just amazing, and so many people don't know about it. I've helped a Starbucks barista get qualified. I mean, it's just amazing to be able to help people do this. And of course, Bob will tell you, you don't do this for the commission, because if you start doing that math, you're actually paying to help the person. But the feeling that you get from helping them is tremendous. And I got most of my business because other agents did not want to do FHA foreclosures, so they referred them all to me. And I would advise you to do the same thing. If you're a loan person or a realtor and you don't want to do these, and don't screw up on a first-time home buyer. Go ahead and take one for the team and give this loan to someone like Bob, or give this purchase contract to some realtor who's had success, because it won't be worth it and you'll look bad. And refer it to somebody who's done a good job. But it's just an amazing program, and I'm very thankful for people like Bob that will take phone calls from people on these programs, because a lot of people just won't do them.
And on that, Mark, I've got a good story. I've got a couple. They bought a BMR in San Francisco, brand new condo, and that's their owner-occupied home. They have since gone out and bought a duplex. They bought a foreclosed duplex in Sacramento as a rental property, and now they're doing another one. They're building up their real estate investment portfolio in other markets where it's easier entry. So they have their primary residence secure in San Francisco on an affordable home, and they're able to now go out and buy investment properties to build up their personal wealth elsewhere. So, when you have limited income and limited funds and you want to maximize your potential in the real estate market, that was an excellent example of how he did that. It's just, just because you're buying a below market rate unit in San Francisco as your primary residence doesn't necessarily tell you, hey, how you doing there? You don't have to you're not limited to buying investment property elsewhere. Thing is, you have to live in that property as your primary residence. That's the only restriction. What you do as far as buying real estate elsewhere is up to you. We got a chatty group here.
The kids have opened up a store downstairs and I had to buy something apparently.
I love it.
I appreciated one of the things that Mark just said about referring it out to someone else if you have a client looking for a BMR. That's exactly what I ended up doing, because I had a client where we made offers on 3 separate units, and just, you know, due to the lottery, we weren't getting anywhere. And so I ended up just going to the go-to BMR person in Marin County, you know, gave it to them, didn't, you know, no referral fee, just please, this woman needs a home, let's help her. And, you know, and she got the next one she bid on. And it's just, it's definitely a process, you know, of knowing, you know, how to have that paperwork be exactly right. You know, it's, but she's really happy. She loves where she lives now. And she wrote me a really great referral letter as a, you know, one of my first, you know, when I was new at this. So yeah, anyway, but thanks for this, Bob. I'm going to have to jump.
Okay.
But thank you. Take care, everybody.
We'll see you, Charlene.
Hi, Sherilyn.
Yeah, I want to let everybody, you know, my most appreciative clients are the ones that actually were able to get a BMR home. You know, they come and bring me presents and all sorts of stuff. Oh, there's chocolate balls for.
For Sherilyn. Hopefully she'll be here next week.
Yeah, everybody, I want, as long as you brought that up, next week we're going to have Enrico do more social chefing, and he's gonna do it on sautéed shrimp and creamy polenta and those fantastic chocolate peanut butter balls that he's got on the screen there. And if you want to come next week, there's the Eventbrite link for it. We're calling it Better Than Leftovers. And we're going to have social chefing on Black Friday for our coffee chat next week. I love to see.
I can vouch for it. His polenta is amazing. Oh my God, I would love to learn how to make it. So I'll have to sign on.
Look forward to seeing you.
There you go. There you go. So anyway, to the BMR programs, you don't have to buy a BMR to take advantage of these first-time homebuyer programs. My favorite is the Cal HFA. You can get up to 105% financing for up to like a $800,000 purchase price. That's amazing. And you don't have to have these income limits like they do on most of the other programs. The income limit in San Francisco, it's the highest cost area in the state, but their income limit is like $236,000. It's a little lower for Los Angeles, in between for Orange County, but you can make a significant amount of money. But if you don't, you know, who has the time? It's expensive to live here or in Los Angeles for that matter. Who has the ability to save up the money for down payment? And that's why these down payment assistance programs are amazing. I think they have 0% interest. They have deferred payments, or like in Gary's case, you only have to hold on to it for 3 years and it's forgiven. It's free money, free money. It's like, it's hard to wrap my head around it. Oh, we got noise coming in. Okay, so, gosh, those chocolate balls are driving me crazy. You guys, we had an event that Enrico catered for us, and it was like ribs and corn, and then he brought these along, and they were so rich and decadent, and nobody wanted to eat a lot of them because they're so rich and full of calories, and I had at least 6 or 7 of them because I couldn't help myself. It's just, I got an incredible sweet tooth. And he's going to show us how to make these next week. You guys got to see it. It's like, I better not do the recipe, because if I start making these things myself, I'm not going to be able to fit in my pants anymore.
I hear you. Actually, I'm on a diet now. Dude, my wife told me I had to get on one because my pants weren't fitting anymore. So yeah.
Now, if any of you remember, Enrico's wife is a weight loss specialist. And each one of them gave us presentations. So I just thought that was a very successful business plan. Enrico gets you fat, and Amy thins you down, and you just have a recycling of a recurring business that way. I think that's brilliant.
Yeah, it's inevitable. You eat my food. There's not going to be much healthy food available because, you know, everyone can make healthy food. Just, you know, boil up some chicken or something, steam up some vegetables. You're there. But no, this is where I'm at right here. So let's see.
Awesome. Well, we're getting close to.
You know, Bob,
Yeah.
I'm looking at Los Angeles County, and their the only thing I came up with was Los Angeles County Development Authority,
Okay.
LACDA, as far as home buyers. And for one person, the max they can make is 61.4.
Okay, so the average median income in LA County is lower than San Francisco for sure. So
Mhm.
that's probably 80% AMI, average median income.
Well, the 80% is 58,450, and the moderate 120% is 61.4.
Wow.
For
So that's
2019, I don't know what they did for 20, but for 2019, that's the chart that's on their website.
wow. They're really restrictive there because like
They're really restricted.
San Francisco changed it from Fannie Mae and Freddie Mac, and I know Fannie Mae and Freddie Macs are higher. So if you did like the Fannie Mae Home Possible or the Freddie Mac Home Possible or Fannie Mae Home Ready, you'd qualify them for a higher AMI than that. I know that. I can't remember the exact number because I remember scanning over those numbers when I put the slides together.
Mhm.
But you know, Los Angeles, it's like I was kind of surprised it was so low.
Yeah.
Orange
It's really-
County's higher, but
Mhm.
Los Angeles is a little different, huh?
I was thinking about it because my niece just had a situation where she was living in an apartment and won a court case against her landlord, and she has since moved out, and she's looking at like $8,000, possibly 8 to 9. And I told her she might want to look into buying a condo or something. So that's why I was thinking about that instead of moving into another location. You know what I'm saying?
No, yeah, I'm just trying to think. What would be something she'd in the purchase price range that she'd be looking at if she's restricted in that income category?
I don't know. Here in LA, the average property, single family house runs 5. You can get condos in certain areas for 2 and 3.
Okay.
So it just depends on where she wants to live. But when I was looking at someone else looking at condominiums and like in Long Beach, we're going for 3, 4, and 5. In
Okay.
my area, houses, I think in this area, houses start around a little above 5 to 6. And the further west you go, of course, they double. Because I'm in Hawthorne, and I found out that there's an East Hawthorne and there's a West Hawthorne. So, so depending on what side of the tracks and large street you're on, you can get something for for 5 and then up. But for her, she was looking at Long Beach, and they had some but they were usually like 1 bedrooms, small ones. 1 bedrooms were running around. So I saw some for 2, 3, 4. So it just depends.
Okay. All right. Well, then that would probably make sense. And in that site there, does Los Angeles have below market rate units for sale too?
No, I just showed you the qualifications as far as, you got to take the class. It said you had to have appropriate credit score, but it didn't tell you what the score was. Gave you the medium income chart. And that's all I saw on there at the time when I looked at it.
Okay.
I'd have to do a little more research to figure out what else was available. But that's what is housinglacounty.gov, and they have different for sale. They have listings. Looks like they might have listings because I just for sale, list your house for sale, or find a home, sell homes. So they do have an opportunity for you to go to find homes that are for sale. So, but when you pull it up, I don't see anything come up. So more than likely, there's nothing there.
Oh, that's too bad. Yeah.
Yeah. Sorry, it says, sorry, no housing was found for the match to your request.
Oh, no.
There may be units available that match your price range. And then it says, click here to view listings. So,
We'll come up to San Francisco. We have a lot more here.
yeah, that's true.
That's
So
why
yeah,
I wanted to show those numbers on everything that's available to sale in the below market rate range, because
Mhm.
you know, if you're lucky, because there's a lot of people that apply for the lottery. I won't sugarcoat that. So it's you know, it's you got to take your chances, but there's so much more available to apply for. And if you don't get one, just keep going. That's what I tell people that I get loans for. You know, it's like, once I get them pre-approved, I don't want to lose them. I just go to the next one, go to the next one, go to the next one. The only frustrating thing is occasionally, especially if it's a resale unit, they'll get picked for the lottery. They'll go look at it and they'll be with a friend and they're nitpicking. Oh, you know, it's like, you know, this is dated and this doesn't look just right and the color's not right. And for subjective things, they will not take it. And it's just like, I want to knock him
Yeah,
around
I
going,
mean,
saying, hey, you know how hard it was for you to get this?
paint Home Depot. Paint and Home Depot. There you
Right. Exactly. It's like, you're lucky to get picked, but getting it picked a second time, if you want to keep it, it's like, oh, you're like stretching the odds on that.
So I know for myself, my first jump in a property was back when I had a what they call a partnership with some friends, which I won't do again. And we found a gentleman walking away from a property for 10 grand in Lancaster in 2006. But what I did wrong as an appraiser, I was at that time, I was upset with myself because as I used to do appraisal, so I knew better, but I did not, you know, really look at what the market was doing. So when I got it in June of 06, by the time 6 months later and Countrywide required us to pay the mortgage to show that we can pay it, the loan to value had dropped tremendously where there was no way to refi. And so I went ahead and decided to rent it out because it needed a little work. He was walking away because of a divorce situation. And then I rented it out. And then less than 8 months later, the renters ran into not having a job, had to move back to Texas. And I end up asking him to do a short sale. And the owner was in the process of buying another property and didn't want to tell me, but he made the mistake of telling my neighbor. And when he told the neighbor referred it to me that he was going to buy another property and just walk away from that one all completely. Being that the loan was still in his name, there was a lot that I could do. So I went ahead and went down to the register recorder and recorded that grant deed back in his name, killed his deal, and walked away. So
whoa, good thing you found out about it ahead of time.
yes. So the person who he told was the person who told me about it in the beginning, that he wanted to walk away from it because they had been a mortgage broker. And so when he told him that he told him that on the Monday, he called me immediately. I said, if I don't hear from him by Wednesday, we're going down to the court and I'm just going to deed it all back to him. And because he had told the mortgage company that he was getting the loan with, that I was taking care of it. So I deeded it back. And of course, when they went to do finals, they found out that he had that property back in his name. And then I got a call, but it was too late now because, you know, you should have did the short sale. You're doing better off. So that was the only thing I had with when it came to buying a house. So I said, well, next time I'm looking at, right now I'm looking at storage unit business, but eventually I would do, I don't think I'd ever just get a single family. I would do 2 or more units.
Okay. Well, everybody, it's noon and we got 6 people left in the room. So, you know, thanks for attending. I hopefully gave you something of value today.
Yes.
And definitely come next week. Let's all get fat on those peanut butter chocolate balls. I can't stop thinking about them now.
All right. Thank you so much, Bob.
Oh, you're welcome. Listen, have a great Thanksgiving, everybody.
Thank you, Bob.
right.
Hey, great
Thank you, Bob.
job on your presentation.
Yeah,
Thank you, Gary.
I'm looking forward to it.
Okay,
See you next
Flo.
Friday.
Yeah, we'll
See you
see you
later.
next Friday. I'm looking forward to it too.
Have a good weekend.
Okay, take care.
And Flo, I'll see you later tonight.
Yep, still
All right.
will.
All right, sounds
bye.
good. All right, bye.